I am Paul Moore from Wellings Capital. I should have introduced myself. And so here we go. 10 ways you can partner with the IRS. Number 1, direct investment. Direct investment. Okay, what I mean by that is if you directly invest in real estate through yourself, through an LLC, some other way, by directly investing, you're directly going to get the tax benefits of the real estate. Now, if you invest in shares of a company, you're not going to get that. If you invest in lots of other things out there, you're not going to get that. But when you own real estate even through a syndication like my company does, if you own a partial, a fractional, or 100% of a piece of real estate, you get these great tax benefits. So number 1, make sure you're a direct owner, either through an LLC, a partnership, etc., in the real estate. Okay, number 2, great way you can save on taxes, hire a tax strategist. Now, people have been confused about this on BiggerPockets when I talked about it. I'm not saying fire your CPA. I'm not saying fire your attorney, but make sure they're a tax strategist. I had a friend named Ed in California, and Ed had paid about $120,000 a year in real estate taxes for many, many, many years. And Ed went to his CPA one day and said, "Hey, I saw this article here about this tax saving strategy. We don't do this, do we?" The CPA said, "No." He said, "Well, why haven't we done this?" And the CPA said, "Well, you could do that. That'd be a great idea and save you a lot of money." And Ed got kind of angry, as we all might have, and he said, whoa, you've known about this already for years, Mr. CPA, and you didn't tell me about this? And Ed said, that's ridiculous. Why wouldn't you tell me? And the CPA took his glasses off, I'm guessing, and said, "Ed, you pay me to be your CPA, which means I do your taxes and I do them well. You didn't pay me to be a tax strategist." And Ed was flabbergasted. He fired that guy and he found another guy who was more strategic. And this other guy, who, by the way, I use the same guy now, he actually taught him all kinds of ways to save on taxes. I hired the guy in 2013 and we were building a Hyatt hotel, and I immediately saved a whole bunch on taxes from just him helping me structure my life. And these next 8 ways, we're talking about 10 ways you can partner with the IRS today to save on taxes. We talked about direct investment and hiring a tax strategist. The next 8 ways are all things that I knew or he taught me. So let's get into some of those. So number 3 way you can partner with the IRS to save on taxes is to use the return of capital concept. If you don't want to pay taxes this year and everything else is structured in the right way, you can actually take some or a lot of your returns as a return of principal or return of capital rather than a profit. Now, if you put $100 into an investment and you take $20 out, that might be 20 in profit, but it could also be 20 of the return of capital, 20 of your 100, reducing your basis from 100 down to 80, okay? Which may have tax consequences later, which we'll talk about. But if you get a return of capital, you don't have to pay taxes on that, right? Well, that is one way you can get money out of your investment and not pay taxes on it, okay? Now, there's all kinds of other issues with that. You've got to hire talk to your CPA, your attorney, your tax strategist, but you can do that, okay? I am not sure. Some people are asking me, am I willing to share his info? Hey, Daniel. Hey, Flood of Sins. Good to see you. You've been on every one of my shows. Thanks, man. Or lady. Anyway, hey, Michael. I reach out to me and at BiggerPockets or at my email, and I will give you 2 or 3 tax strategists names, or you can look around BiggerPockets because there's some great tax people on BiggerPockets. One of them writes articles for BiggerPockets, and he's a CPA, so you can probably find him. Hey, Will. Hey, Carolyn. Okay, so number 3, use return of capital. Number 4, use cost segregation. I'm pretty sure this is the technique that set Ed over the edge to fire his CPA because he wasn't using cost segregation. Cost segregation is a tool to get to what you actually want. And what you actually want is accelerated depreciation. You all know that if you can defer the payment of taxes till later, you can compound dramatically faster. And if you haven't looked into that, you can Google it. Accelerated depreciation means this. When you buy an asset, let's say it's $2.75 million apartment complex, you depreciate that on what's called a straight line depreciation method, okay? So it depreciates down by $100,000 a year over 27 and a half years. That's a real IRS number, I know, right? 27 and a half. But, and it could be 38 years in some cases. Again, I'm not a CPA and I don't play one on BiggerPockets Live. But at any rate, you can depreciate that evenly, $100,000. You can take it off of your taxes, okay? You can't take all $2.75 million up front. You take it slowly in an even increments. Now, if you do a cost segregation study, they'll go in and they'll do a study and they'll say, okay, how many lights do you have? How many countertops, refrigerators, carpeting, flooring, landscaping, parking lot finish, parking lot stripes? All these things can be depreciated faster because they're going to wear out faster, right? Cabinets are going to wear out faster. All the plumbing in your sinks and all that. Electrical outlets, all kinds of things, they're going to wear out faster. So the IRS says, okay, you can put those in shorter buckets, okay? Now, if you can take about 30% of that $2.75 million and cram that into the first 5 years, guess what? You or your investors are going to be able to get a return on investment every year. It could be a return of capital, by the way, which I mentioned earlier, but you're going to be able to get a return on investment. Let's say you're going to get a $100,000 check in the mail, but you're going to show a loss on your K-1 or a loss on your tax return, okay? And that could happen for about 5 to 7 years, and there's loss carry forward. So you're allowed to carry forward what you can't use in, let's say, 2019 into 2020, 21, etc., until you can use it. And so this is a very powerful concept because it allows you to accumulate cash without showing a profit on your tax return. It's very, very powerful. And it's one of the most powerful things that the IRS allows or the government allows real estate investors that you can't get in other places. So it's accelerated depreciation using a cost segregation study. Cost segregation studies will cost you a few $1,000 typically. Sometimes they'll cost $3,000 or $4,000 for a large property. Sometimes they'll cost $12,000, but they pay you back in spades. In fact, cost segregation experts say you'll be paid back many, many times over, and they prove it on paper, many times the cost of the study, even in the first year typically. By the way, hey, Topher, good to see you. My name is Paul Moore, and so you can reach out to me at my BiggerPockets profile at Wellings Capital. Justin Freeman says the return of capital as a distribution, isn't the profit still taxed as the return doesn't reduce income? That's getting into the finer details. But I can tell you that a return of capital is something you can sometimes do. And I'm not saying in place of a distribution. I'm not talking about anything shady. I'm talking about what if your first, let's say you invest $100,000. What if your first $100,000 in returns are all return of capital and your profit comes later? Okay. So all kinds of spreadsheets and studies out there are proving that that is a powerful way to compound your wealth dramatically and to grow to a much faster, higher place. I don't know if we want to get into it on this show today, but I showed in my last episode how you could take $100,000, and if you can work the tax system completely legally, you can turn that into about $5 million over 30 years. You can be a millionaire and never pay taxes. You say, Paul, how can I be a millionaire and never pay taxes? Well, keep listening. Okay. John, this is awesome. Thanks for sharing. Thank you. Please give us a thumbs up, a heart, a share, a like. Appreciate that. I got 20 thumbs up over here on YouTube. We're doing a contest today. And how many do we have on Facebook? I don't know. Somebody tell me. Okay. I'm going to get distracted here and never get through this information. So, number 1, directly invest in real estate. Great tax benefits. Number 2, hire a tax strategist. By the way, Ed, who was paying $120,000 a year in taxes, started paying zero. And for the next decade, he said he paid zero in taxes after he hired a tax strategist. And the main things he did, I'm going to talk about today. Okay. Hey, Christine. Hey, Kevin. Thank you for the likes. Okay. So we're talking about how to save on taxes. John, thank you. Okay. Number 4, I went over. Number 3, I talked about return of capital. Number 4, cost segregation. Number 5, correctly classify fully deductible repairs. I had a $77,000 repair at an apartment building we owned yesterday. And it was actually the water pipe under one building. Okay. So the water pipe had apparently rotted or been severely damaged under one building. I don't know why it would rot already. It's wrought iron or cast iron, and it's only 66 years old. No, it's 56 years old. It's not even 60 years old and it already rotted. Go figure. But a $77,000 repair. Now, if I put that in as a capital expense, I could depreciate that $77,000 over 27 or 38 years or whatever. Boo! That's not right. That should have been a repair. It's completely deductible this year. Guess what? If my profit on that apartment complex is, let's say, $70,000 this year, and I do nothing else except this one repair, and I take that whole repair in on my taxes this year, I have a $7,000 loss on my taxes, and that's how it should be, right? Well, some people will classify that as a capital expense. Well, you put in new piping, you put in all this, $77,000 worth of work, that should be depreciated over several years. Bad idea. Fully deduct all the repairs that you can in this year. Okay, that's reason number 5, that real estate investors have incredible tax savings. Number 6, refi tax-free. By the way, there are certain limitations to this that I don't understand. Sorry, but think about it. If you have a house and you go to the bank and you have $100,000 extra in equity because you heard Paul Moore on BiggerPockets say you could take $100,000 and passively invest it and turn it into $5 million over 30 years, if everything goes according to plan. You take that $100,000 refi, you pull that money out. How much do you pay the tax man? Zero. That's right. You pay zero. It's the same with commercial real estate. If you refinance your property and give a return of capital, by the way, return of capital, right, back to yourself and your investors, you don't have to pay taxes on that. And it's a great way to get cash flow without getting taxed. If you like that, give us a thumbs up, give us a heart, give us a like. We'd love to hear your feedback. Okay, so I'm going to take a look and see if there's any questions, complaints, comments. If you have complaints or comments, or you just hate what I'm saying and you actually like paying taxes, please let me know. It's okay. I would love to hear from you. Okay, let me see if I got any questions at this point. Hey, John, nothing. That's right. Gamma Fighter. Hey, Gamma Fighter. Glad to have you on this Saturday. What should I expect out of my first investment, a house hack? I hear about this house hack on BiggerPockets that fully covers all expenses, but apartment investors expect $75 to $100 in cash flow per unit. Okay, I am going to let someone else who's actually house hacked answer that. So if you have an answer for Gamma Fighter, please, if you're on YouTube, give them an answer, because I've never house hacked. I wish I had. I heard a funny story about a house hack the other day, and if somebody here will remind me, I'll tell it at the end of this show. Hey, Christopher, Jeremy, thumbs up. Sandra, that's awesome. All right, so refi tax-free. Hey, Timothy Hooper, thanks. That's nice. Okay, number 7. We could spend the rest of the day on this one. 1031 exchange. You guys probably already know about this. We could probably move on, but 1031 exchange means at the end, let's say you have had this investment for about 6 years and you've made a lot of profit and you've done a return of capital and you've got your basis paid way down. Don't worry about that if you don't know what it means. You do not have to pay capital gains on that if you do a 1031 exchange. And the way this started is the IRS, the government, realized that some people don't sell their properties, therefore they don't have cash. They exchange it. So if you take your farm and you sell it and you make, let's say you get $1 million, but you immediately buy another farm for, let's say, $1 million, how are you going to pay the capital gains? Let's say your capital gains on that should have been $100,000. Well, you have no $100,000. So the government recognized this tax-free, it's actually tax-deferred exchange, okay? And so that's a 1031 exchange, and they expanded it after they started with real estate. They expanded it to boats and cars and my friend's jet plane. All these things they expanded it into, and they call it a like-kind exchange. You can't exchange your piece of land for a truck or your jet for a car. Okay. By the way, so the IRS in their wisdom allowed all these other types of exchanges. It's a like-kind exchange, but in the tax reform bill that just came out December 23rd of 2017, they eliminated the 1031 exchange, and real estate investors were really scared, but the rumor wasn't true. They eliminated it for the cars, trucks, airplanes, Lego sets. I made that one up. All these different things, they eliminated it for that, but they kept it in force for real estate investors. Who wants to give the government a thumbs up for keeping the 1031 exchange for real estate investors? Well, they did, which means you can still do this. And it means if you, like the guy I knew who exchanged his duplex for a fourplex, then his 4 for an 8, then his 8 for like a 20, and then his 20 for several single family houses, the single family houses for a 30 unit apartment. And when I met him, he was selling his 131 unit apartment complex for $11 or $12 million. And if he did an exchange again, he was able to basically kick the can down the road and move that ball forward and never pay capital gains tax all these years. Now, I told you earlier that I had done a calculation on the show the other day about how to turn $100,000 passively invested into $5 million over 30 years. Now, that was assuming a 20% annual total return, which is very doable in real estate, especially when you count the cash flow, the appreciation, the principal pay down. Apartment owners have been doing 20% returns for years. Storage unit owners are doing much more than that right now. But let's assume it was only a 10% return annually instead of 20, and that's very possible in the future, okay? But still, the point is this. If you did the 1031 exchanges and you didn't pay capital gains tax all along the way, you would have, let's say, $5 million, okay, in 30 years. If you did pay the capital gains, every time you did an exchange, you paid, let's just say, 15%. Your growth, instead of to $5 million, would have been to $3.5 million. Now, you would have paid all your taxes along the way, but now, think about it. You'll never catch up to that $5 million from at least that original investment because you paid taxes all along the way. So using a 1031 is powerful. And at the end of the show, if somebody reminds me, I'm going to tell you a bonus to show you 2 different ways to never pay that capital gains tax. Okay, the 1031 exchange is designed to kick the can down the road and eventually pay the capital gains tax at the end of the road. But I've got 2 ways out that will show you not to pay how you cannot pay the capital gains tax at all, okay? So if you believe that, or if you want to see me go into those 2 ways, give me a thumbs up, a heart, a like, even a share. Hey, Jeff Turner, do the properties have to be purchased by the LLC or simply deeded over to the LLC if purchased by an individual? My son, I've talked about on here before, is buying large tracts of land in Southwest Virginia in the mountains, and he says that all the time he sees people who own property who just deeded it into their LLC later. So I'm not, like I said, I'm not a CPA or a tax attorney. So apparently you can. Jesse says, can you do a 1031 from mutual funds or IRA to real estate? I don't think so. I wouldn't think so. That'd be a good question for a CPA, tax attorney, etc. Justin Bradford said, if you give property to LLC, it might trigger the due on sale clause. Very good point. Mortgages have a due on sale clause. And I have heard and I've experienced personally that if you put it into a land trust and you keep paying your mortgage, that it will not trigger the due on sale clause. I'm not an expert in land trusts. I've just used them a few dozen times, and they're good for protection, and they might not trigger they might not trigger the due on sale clause. I don't want someone coming back to me years later and say it didn't work. So, hey, John Gulori, sorry if I didn't pronounce that right. Ben says, I'm currently paying $40,000 for my rehab. I'm still confused on how to count everything in year one. Oh, we're going to get to that. Okay. So, self-directed IRA is number 8. Actually, I'm going to take a little detour. Did you know that you can fully deduct certain items through a section? Somebody tell me if it's section 79 or 179. I actually know. I just thought of what it was. But I'm going to let somebody else tell me if it's a section 79 or 179. But this section in the IRS code allows you to deduct. Like when I was first getting into business as an entrepreneur, they upped it from like $2,000 up to $10,000 a year. I could buy $10,000 a year in computers and BlackBerry phones and printers and all this and deduct it fully that year. It wouldn't have to be deducted, over 5 years, 7 years, 15 years, or 27 and a half years. Okay, that's the kind of the depreciation timeline. It wouldn't have to be depreciated is the word I wanted to use. But guess what? The government in December of 2017 said we're going to dramatically raise that ceiling on the section. Has anyone guessed it yet? Okay. We're going to dramatically raise the ceiling on this, and we're going to allow you to deduct massive amounts of money in the current year. So someone just asked, how do I deduct it in the current year? It's section 179 of the IRS code. It will allow you to make large deductions in the current year and not depreciate it. This is a massive tax savings. And so if you have a 20 building apartment complex with, let's say, 10 units in a building, that's 200. You can do the math. I can do the math. 200 units. And you put new roofs on all those. Guess what? In the old days, you have to deduct those roofs over 27 and a half or 38 years. Or if you did a cost segregation study, which is the fourth path today to saving on taxes, you could do it in maybe 15 years. Guess what? You may be able to deduct the entire cost of all those roofs right now, this year. Imagine the tax savings. Imagine the tax savings. And the government, the new tax reform bill allows this massive increase in tax savings for real estate investors. So pretty exciting. We can talk about that a little bit later. Yes, section 179. Thanks, Bayo Biz. Flood of sins. Why do they say if you save someone from foreclosure, such as a pre-foreclosure sale, you save their credit, when usually they will have to sell to you for far less than what they paid? Well, if you have a bankruptcy, I believe it comes off of your credit in about something like 5 or 7 years. I've never had one, so I don't know. But if you have a foreclosure, I believe it stays on your record forever. So if you can help someone avoid foreclosure, you're definitely helping them out. Okay, and if they were going to lose the property anyway, if you come in and sweep in and buy it, you can at least save that from being on their record. Okay. So we've went over 10 ways you can partner with the IRS to save on taxes, but we're only at number 8. And number 8 is through a self-directed IRA. I had a 401k at Ford Motor Company. I never dreamed that I could actually manage my own investments. I thought, okay, Fidelity and Vanguard, these are my choices, and there's like 5 different funds I can invest in. Well, guess what? As a self-directed IRA holder, you can choose to invest wherever you want. Now, you can't invest in your own deals necessarily, okay? You can't invest in your own house, You can invest in your own deals. I'm not going to get into that detail. A lot of self-directed IRA rules would say you can't invest on anything where you're going to make a personal profit, is what I meant to say. So if you have $100,000 you need and you take $50,000 out of your IRA and $50,000 out of cash, if you're going to make profit on that, or let's say you're going to go in and be your own contractor, they will not allow that. But you can use a self-directed IRA to get massive tax savings, to free up capital, to do other things. You can invest that, and then you get all your profits tax-free. Now, a Roth IRA is actually money that was already taxed before it went in, and you can do a self-directed Roth IRA, and then you can actually take those monies out tax-free at the end, but not only tax-free forever. Okay, a SEP IRA, you have to pay taxes at in theory, lower rate way down the road after you're 59 and a half years old or older. But a self-directed IRA, you can take a 401k or a regular IRA and roll it over to a self-directed IRA. And there's lots of companies who will do that. I have mine with Equity Trust Company. And there's a lot of people who will manage this for you. And I want to give you a big warning. Number one, treat the self-directed IRA money just like you would money out of your personal bank account. Don't just treat it casually and say, oh, it's only self-directed IRA money. I'll just take this bigger risk. I did that and I lost a lot of money doing that, okay? Don't do that, okay? Number two, please understand that there could be tax consequences if you invest in something that has debt. It's called the UBIT tax, UBIT, and I won't try to unpack that right now. BayoBiz says active passive activity rules may impact the 179. Thanks, BayoBiz. Okay, I don't know about that, but it sounds sounds like it's something that's important that you need a tax strategist for, which is number two method of saving taxes today. Okay, we're going to go on to number 9. Avoid passive loss limitations by becoming a real estate professional. If you spend at least about 750 hours per year doing real estate, you can be reclassified as a real estate professional and you can get all kinds of additional deductions. BayoBiz, if you know what they are, please let me know because it seems like you know something about taxes. I don't know what they all are, but if you can be classified pretty much as a part-time, 750 hours or more, or a full-time real estate professional, you can get additional tax savings that you can't just get as a passive investor, okay? Now, I talked earlier about different changes from the Tax Reform Act. I'm going to hit that right now. Okay, so number 10, way of partnering with the IRS to save on taxes. High net worth individuals, I'm reading this, will receive a 20% deduction on income from pass-through business entities. This applies to ownership via partnership, LLCs, sole proprietorships, and investors in public and private real estate funds. So if you're a high net worth individual, you can actually get a 20% deduction on income from your pass-through entity, which could be yourself. And that is number 10. Number 10 way of partnering with the IRS. And that is to be alive and be an American taxpayer in the year 2018, because this law was passed December 23rd, just in time for the holidays last year, 2017. Now, if you like that, a 20% additional deduction from real estate, give us a thumbs up, give us a heart, give us a like, okay? And I'm going to give you a bonus today. I didn't promise this up front because I forgot, but there's a bonus. The Tax Reform Act had a couple other bonuses, and one of them is this. Taxpayers can factor in 2.5% of the original purchase price additional deduction on real estate, on your real estate taxes. So the combined effect of the 20% savings and the 2.5% savings could take you from a tax bracket of 39.6% right down to about 29.6%. And so that's a 10% savings, but it's 10 out of 39.6. 10 divided by 39.6, BayoBiz, it's about 25%. So 25% savings in taxes being a real estate investor. Who likes that? I like it. I like this new tax reform bill. It's the most powerful tax reform change since the 1986 TRA, Tax Reform Act, when I was a senior in college. By the way, I'm dating myself. Ronald Reagan was president, and it was a great tax reform bill, but this one is amazing. Justin Freeman says, whoa, the 2.5% is the limitation, not additional. Okay, well, maybe I'm wrong on something there. What is a high net worth or high income individual? Eric, I don't know how they define that. That's why we need a tax strategist. Justin Freeman, boy, I just really shucked that off, didn't I? Justin Freeman says, look for the grouping election as well as to become a rep, as all entities are an REP, as all entities are treated separately in regards to hours needed. Okay, that's great. Habib says, what? That's good. Hey, Habib, I like it too. Just rolled over 2 months ago, Timothy says, and that must mean you rolled over from an IRA to a self-directed IRA. I want to tell you that if you're a really sporadic person that kind of makes quick decisions, takes big risks, it may be better for you to leave your money in a regular IRA. By the way, if you have a self-directed IRA, you can still invest in Vanguard and Fidelity and all those regular mutual funds. You don't have to put it in crazy real estate investments, but you can choose to. A lot of people who are real seat of the pants and who are speculators, not investors, actually lose money in their self-directed IRA that they might have been able to hold on to if they would have just left it with Fidelity or Vanguard and rode the ups and downs of the market. I know it's hard to believe I'm saying that, but I am saying there's a difference between speculating and investing. Investing is when your principal is generally safe, like in a cash-producing real estate asset. When your principal is generally safe and you have a chance for a return, that's investing. Speculating is when your principal is generally not safe at all and you have a chance for a return. They sound really similar, don't they? But they're not at all. When I sent $75,000 down an oil well in the Bakken region of northwest North Dakota, I knew it was going to return like 10x. Well, it actually returned nothing, including my $75,000. So I was telling people I'm an oil investor. Hey, I'm an oil and gas investor. Hey, how you doing? Like a big cigar here in my hot tub. But actually, I was a speculator, okay? If anyone on here has suffered from the not knowing the difference between being a speculator and an investor, please, I hate to say give me a heart, a thumbs up, but give us some kind of a like on that, because we are going to relearn what it means to be an investor by investing in solid, cash flowing, cash producing real estate investments, okay? BiggerPockets is a place to learn that. By the way, if you're not a BiggerPockets Pro member, reach out to me. BiggerPockets Pro has incredible discounts, values, real estate tax forms for all 50 states, I believe. All kinds of discounts on mortgages and closings and appraisals and inspections. You have to be a pro member to get this stuff. So check out BiggerPockets Pro. It was the best. Being on BiggerPockets and then becoming a pro member was the best decision I've made in 29 years of being in business for myself, and I'm totally serious, okay? My assistant, Ben, talked me into it, so thanks, Ben. Okay, Leslie Fisher says, can you recap number 9? Yes, avoid passive loss limitations by being a real estate professional, okay? So there's some cap on the passive losses you can take as a passive investor. If you have a job in tech, a lot of my friends on BiggerPockets have jobs in tech around the Bay Area, and they invest passively in real estate. Well, there's some kind of limit or limits to what you can take as deductions. But if they're a real estate professional, you can take larger losses or deductions on your tax return, okay? Don't know what they are, but I do know they're there. That's why I hire a CPA, okay? And I recommend hiring a tax strategist type CPA. So Carolyn says BP Pro is the way to go. I agree. Justin Freeman's probably going to tell me I'm wrong. The 20% is the deduction limited to 2.5% of the property's unadjusted cost basis. Seriously? Okay. So y'all, I probably made a mistake in my article, and that makes total sense, actually. Have you guys seen the new book by BiggerPockets, by the way, Raising Private Capital by my brother? Have you seen it? If you've seen it, give me a thumbs up, okay? Now, I want to say that I'm probably wrong on this tax return reform thing, and I'm actually looking quickly. That's why I'm distracted here. But, okay, I have an article that came out on BiggerPockets called The Dark Side of the New Tax Reform Act for Multifamily Investors. And if I would have had Justin Freeman help me edit it, he might have said that the 2.5% was the limit of the 20% savings, okay? But I actually read the 2.5% thing in an article on NREIT. In fact, I referenced that, and so they must have made the same mistake. So I'm guessing, Justin, you're right. The loss limitation is $25,000 phased out at a certain amount. Thank you. All right. So if Justin's right, I'm wrong, and it won't be the first time, because I do have a podcast called How to Lose Money. And we talk about lots of mistakes I've made. And you can learn more about how to lose money, actually how not to lose money, by joining us on iTunes or Stitcher or Google Play for How to Lose Money. The dark side of the new, okay, I got it. So the dark side of the new Tax Reform Act for multifamily investors. And that was an article, that was a post I made on BiggerPockets. It talks about some of these tax savings. And I made an earlier post about a year before on BiggerPockets that has these other 8 or 9 tax saving devices. So we're going to go over them again, and I'd like you to go ahead and start posting your questions. Thanks, Justin. I'd like you to start posting your questions here, and we will start hitting those as soon as I go over these 10 again. Okay, 10 ways you can be a millionaire and never pay taxes. That's an old Steve Martin gig, by the way. 10 ways, seriously, you can partner with the IRS to save on taxes. Number 1, directly invest in real estate through an LLC, partnership, everything. Hey, Markeen, thank you. Number 2, hire a tax strategist like my friend Ed, who paid $120,000 a year in taxes and reduced his tax bill to $0 a year after he hired a tax strategist. Number 3, use the return of capital principle. Number 4, cost segregation to give you a chance to accelerate your depreciation. Hey, Eric, buying it soon. Hey, Mike, I own a property that I own outright. That's awesome. Okay, cost segregation. Number 5, correctly classify fully deductible repairs. Number 6, refi tax-free. There's limitations to that I don't understand. Number 7, 1031 exchange. And I promised you at the end of this, I would tell you the way to avoid taxes forever by kicking the can down the road with the 1031 exchange. And I will. Number 8, self-directed IRA. Self-directed Roth or self-directed SEP IRA both work incredibly. One time I invested $100 in my self-directed Roth IRA. I bought an option, and I actually made like $93,000 from the option I bought, and that went into my IRA as a profit on the $100, and it's tax-free. That was like 12 years ago, but I remember it well. It was a happy day. And that's before I invested in the oil well. I didn't invest. I speculated. Okay, you all know. Number 9, avoid passive loss limitations by being a real estate professional. And number 10, be an American in 2018 and pay 20% up to 20% less on your taxes because of the new tax reform bill. Okay, so that's it. So how can you you say, Paul, how can I kick the can down the road and save money on 1031 exchanges all through my life and then never pay taxes at the end? There are 2 ways. Number 1, you ready? On your last 1031 exchange, according to what everybody who I've asked has told me, you can buy a single family residence or some other type of real estate that you want to move into, and you can rent it out for 2 or more years. After you rent it out for 2 or more years, you can move into it yourself and never pay the capital gains tax. You can accumulate tax deferrals for like 30 years along the way, or 3 years along the way, whatever. And then at the end of the line, after 2 years as an investment property, you might change your mind and that become a personal residence, and you never have to pay that capital gains tax that's accrued over all these sales for all these years. I want to be really clear. Not a tax professional, and I've got to believe there's some kind of limitation on this. Justin, somebody else, if BayoBiz, if anybody knows what the limitations are on that, tell the group, please. You guys are, one of you on Facebook, one of you on YouTube, it'd be okay. Markeen says, are you doing okay, sir? Yeah, I'm doing okay. Do I not look okay? Let me check. I think I'm okay. So, one way is to move into your final 1031 exchange property, okay? And I know a guy at Smith Mountain Lake in Virginia who's doing that exact thing. He bought he traded in dozens of apartments and single family and duplexes. And now my hair's messed up from trying to be silly. He traded in dozens of these apartments and single families and all that. And he bought a really nice waterfront home at Smith Mountain Lake. And according to him, his 1031, his CPA said after 2 years, he can move into it and never pay the capital gains taxes that he should have accrued. Pretty amazing. Okay? Now, the second way to never pay that capital gains tax is to die. That sounded really morbid, didn't it? I watched I Am Legend last night. Man, that was something else. Lots of all those like dead people walking around, zombies. It wasn't, Sixth Sense. But anyway, seriously, if you are still holding real estate and you're like, let's say you're really old, or let's just say you're about to pass on to the next life, and you sell all that, pay the tax, and leave your kids the money, they're going to get the after-tax value, and that can be a huge tax hit. But if you leave the real estate intact and you pass away, your heirs should get a step up in basis. And that means if you got real estate for years and years and years, you accumulated it. Let's say you had $1 million into the real estate, but it's now worth $5 million. Just to make it simple, you're going to have a capital gains burden of about of the tax on the difference, the profit, the $400,000 in capital, $4 million in capital gains. Okay, guess what? If that real estate's intact and you pass away, they can get it revalued for the new value, and the baseline is now not $1 million but $5 million. They don't have to pay tax. By the way, that works in all 50 states, from what I understand, for your heirs. I've heard it only works in 5 states if your heir is your spouse, okay? So you can check into that. I don't know what states, but I do know it's powerful, okay? So those are 2 ways to kick the can down the road right into eternity. And one is move into your house after over two years or more. And the second way is when you die, they can get a step up in basis up to a certain limitation. Okay, I'm going to do questions from here on out because it is 12:53 Eastern and we're almost out of time. So Ben Colley says, Robert Heflin IV, this video will be on YouTube and BiggerPockets later. Thanks, Ben. Justin Freeman says, if they sell the property before death, there may be a tax then. That's exactly right. Yeah. Death is the best tax strategy, unfortunately, because of the step up in basis. Yay, Justin. Thanks. Eric says, can you buy a house with an LLC and then rent it to yourself to make all the expenses deductible? That would avoid some taxes. I don't know. Justin, do you know? Bayabiz, do you know? I don't know. I never really thought of that before. Okay. So thanks, Ben Colley. Ben Colley is the most amazing operations manager. He works for Wellings Capital. Give Ben a thumbs up if you know him. And I'm glad he's on here today. Leslie Fisher says, I have only 3 single-family rentals. Would I benefit from having a tax strategist? Okay. By the way, the tax strategist will tell you that if you have a house or a property $100,000 in value or more, you could benefit. And by the way, you don't want to get an engineered cost segregation studies are great. They're much, much more expensive. There's also just your basic cost segregation study. I've heard if your house is over $100,000, you can benefit from it. I've heard other people say you need to be in the several $100,000 range before you get a real tax benefit. So actually ask your tax cost segregation study person. By the way, I know some. You can reach out to me on BiggerPockets if you want a cost segregation person, or you can go on BiggerPockets and find one. Thanks, John. How to get a tax strategist? Reach out to me directly. One of the BiggerPockets writers is a tax strategist. And actually, Ben, if you happen to be on YouTube or Facebook, you can post that. Markeen, are you doing okay? Yeah, I'm still doing okay. Leslie, thanks. I'll check into that. I did the same as you and lost 20,000, says John Giori. I'm sorry. I lost a lot as well. But real estate, by the way, I was $2.5 million in debt in 2007 and 8, going into the worst financial crisis since the Great Depression. And I've got an article on BiggerPockets talking about how I went from $2.5 million in debt to debt-free in 13 months. And it's something like how coming out of $2.5 million in debt caused me to live a charity-focused life, which is kind of an odd title, but if you look up Charity Focused Life or me, you can find out how I got out of $2.5 million in debt by WWGMD. That's not what would grandma do. What would George Mueller do? If anyone knows who George Mueller is, give me a thumbs up. He's awesome. Lived in Bristol, England through the 1800s. Ben M says, hey, Ben M. I am spending $40,000 on my rehab right now. What is the best way I can make sure to take that against this year's earnings? Ask your tax strategist, CPA, or tax attorney. I don't really know if all that would be deductible, but I hear that the new tax law allows incredible deductions in the first year. Jeff Turner, I already talked about that. Brad, hey, nice job today. Thank you. Hey, thanks. Appreciate that. Thanks for the smiley face, the heart, the share. Ben Colley, what is our final count? We were doing a count today between BiggerPockets and YouTube to say who gave us the most likes, shares, thumbs up. Ben's going to help me by telling me how many we got on Facebook, if he's still here. And then I'm going to figure it out on YouTube because I'm not a millennial. And we've got 39 thumbs up over here on YouTube. Awesome, guys. Okay, so what else? Any other questions? We're going to wrap this up in a very, very few minutes. Ben Colley says, message me, that's Paul Moore, of Wellings Capital on BiggerPockets, and you can get more information. Most of the time, Tax Strategist will do an initial consultation to see if it makes sense for you to work with him. Do you know I saved a ton of money from just doing what my tax strategist told me to do in my free initial consultation? I'm kidding you not. I saved, so FICA is Social Security and Medicare, and it's 7.65% up to a certain level, and then it goes on a little above that. And the FICA is 7.65% to the employee, 7.65% to the employer. If you're self-employed, that's 15.3% total. My tax strategist showed me an incredibly simple way that I actually knew, but forgot years before, of saving a ton of money on FICA, because a lot of what I was doing was semi-passive. A lot of my money came from investing, but I was running it all through as FICA, as money that would have to have FICA on it. If I had taken $100,000 in those FICA taxes I paid, then I wouldn't have that in my Social Security stream for retirement. I am so glad to have that in Social Security, where they're taking really good care of it and investing it wisely, I'm sure. But it is in Social Security. If I would have taken $100,000, that was tongue in cheek, just like my 10 reasons not to invest in real estate. But if I'd taken that FICA money, $100,000 of it, and put it into commercial real estate, especially in storage units or value add Class B multifamily or some other amazing things, that $100,000 could have been over $1 million by now. But it's gone, and it's actually not gone. Of course, it's saved for me for my retirement from Social Security. Hey, thanks, Justin. Appreciate that. Ben Colley, 64 on Facebook. Okay, Facebook's ahead. So we got 42 likes on YouTube. Carolyn Lawrence says, who's your tax strategist? Reach out to me on BiggerPockets, and I will share that. Hey, Nap, thank you so much. Okay, we're going to wrap it up. It's 1 o'clock Eastern. Got a few more items. Number one, if you share this, if you like this, if you give a heart, thumbs up, all that stuff, it allows BiggerPockets to help more real estate investors like you and me. And so we really appreciate if you would do that. Also, if you're not a BiggerPockets Pro member yet, reach out to me and I'll try, I can't promise, to get you a discount code to be a BiggerPockets Pro member. I know the one I used before is called Let's Invest. That's all one word written out, no hyphen, no space, LETSINVEST in all caps. I don't know if it has to be in all caps, but that's a coupon code to save money on BiggerPockets Pro. And I highly, highly recommend. Ben Colley will tell you it's the best decision I've made in 29 years in business. I married my wife 31 years ago, so if she's watching, honey, that didn't include marrying you, okay? Marie Free says, so glad I tuned in today. I'm a newbie and I learned a lot. I Had a small tax prep business for several years. My clients were mainly regular people. So now they're irregular. I'm sorry. That was terrible. Okay. Vegan in 2016, let's invest. Yeah, on all caps. Thank you for printing that on there. So we're going to wrap up today. Join us next time here on BiggerPockets Live, YouTube Live, or Facebook Live. And I'm going to sit here in front of the computer and go back through the questions and see if there's anything else I missed in the next few people. Thank you for joining. Next few minutes. And again, we'll see you soon here on BiggerPockets. By the way, being a commercial real estate investor means that I can leave the country with no cell phone, no internet coverage. I'm going to Northwest Ontario fishing with my son at one of those fly-in lakes. So we're flying into the lake in a 1943 Army airplane, which could be terrifying. But anyway, we're going to be flying in, and when we fly back out, we'll see you here again at BiggerPockets, YouTube, and Facebook Live. Thanks. Have a great Saturday. Great weekend.